Feeling lost in the sea of investment options? You are not alone. With so many choices, mutual funds, cryptos, stocks, ULIPs, it's easy to feel overwhelmed. Don't worry. By the end of this video, you will have a clear financial plan that can put you ahead of 95% of investors. So, are you ready to make 2025 your year of financial growth? Without further ado, let's get started. Investing today feels like navigating a maze. Ads are everywhere, promising guaranteed returns, endless hype around cryptos, small cap stocks and mutual funds, and unlisted stocks. All this noise makes it hard to know what's real and what is a scam. Well, here is the truth that most people lose money because they either blindly follow trends or don't understand the basics of investing as to where they are putting their hard-earned money. In this video, I will simplify everything for you. We will talk about what to avoid, why it is risky, and the investments you should focus on to grow your wealth steadily and safe. Let's start with what you should avoid. First up is ULIPs, Unit-Linked Insurance Plan. These are marketed as two-in-one product, insurance plus investment. That might sound convenient. Well, here is the catch that you end up paying high fees for everything: premium allocation, fund management, and administration. These fees eat away your returns, and you can't easily switch out of a ULIP if it is underperforming. So instead of a ULIP, buy a term insurance plan for pure protection. It's cheaper and it gives your family financial security. And for the investment part, go with mutual funds for better returns. Next, let's talk about cryptos. Bitcoin, Ethereum, Dogecoin. They have been all the rage. But here's the deal. Cryptocurrencies are highly volatile. They can rise and fall by 50% in a single day, and there is no clear regulation for cryptos unlike stocks or mutual funds. If something goes wrong, there is no legal protection. Plus, cryptos don't generate cash flows and dividends. They depend entirely on demand and hype. So if you are curious about cryptos, treat it like an entertainment, not investment. Invest only what you are willing to lose, maybe 1 to 2% of your portfolio. But remember, this is not a serious investment. Now let's talk about penny stock. These are shares of small companies trading at low prices, and many people think if I buy, let's say 1000 shares for rupees 10 each, I will make huge profit when the price doubles. But here, the problem is that these companies lack transparency as they often don't disclose their financials properly, and many penny stocks are manipulated by pump and dump schemes. If a stock is cheap, there is usually a reason. It could be bad management, heavy debt, or a poor business model. Instead, consider investing in blue chip companies or index fund that tracks the Nifty 50 or Sensex. These are stable, reliable, and proven performers. Next on the list is risky bonds and P2P lending. Some platforms promise high returns through low-rated bonds or peer-to-peer lending. But here is the truth that low-rated bonds, that is, the bonds that are rated BB or lower, are risky because the issuer or company might default. And with P2P lending, you are lending to people who couldn't get loans from banks. So if they don't repay, you would lose your money. Instead, stick to high-rated bonds like AAA rated or government-backed investment schemes like PPF or NSE for safe returns. Now that we have covered what to avoid, let's talk about what you should do to stay on track. First up, get yourself a term insurance. It's a pure life insurance product that pays a large payout to your family if something happens to you. Here is what you should keep in mind while opting for a term insurance. The coverage amount should be at least 10 to 15 times of your annual income. So let's say if you earn rupees 10 lakhs a year, aim for rupees 1 to 1.5 crores. Also choose a policy that covers you until retirement, until you turn 60 to 65 years. Lastly, skip riders like accidental death or critical illness until it is absolutely necessary. Next, let's talk about health insurance. This covers medical expenses during hospitalization, surgeries, or critical illnesses. Few things you should keep in mind while opting for a health insurance is that you should decide your sum insured wisely, as these days healthcare costs are rising rapidly. Also check if the insurance provider has tie-ups with hospitals for cashless claims in your area. Look for policies with a short waiting period for pre-existing conditions, and don't just go for the cheapest plan. Ensure it offers comprehensive coverage. Next, build an emergency fund. This acts as a cushion for unexpected situations like job loss, medical emergencies, or urgent repairs. Save at least 6 months of living expenses. For example, if your monthly expenses are rupees 30,000, aim for at least 1,80,000 in your emergency fund. Now, where you should park your emergency fund? Keep it in a savings account for instant access, or consider liquid mutual funds for slightly higher returns, around 4 to 6% annually. The goal here is to have it readily available when you need it, not to earn huge returns. Let's move on to retirement planning. Start with NPS, as it offers tax benefits and helps you build a retirement corpus with a mix of equity and debt investments. You can open an NPS account online and choose between active choice, that is where you decide the equity debt ratio, or auto choice, where it automatically adjusts based on your age. Start with rupees 5 to 10,000 annually and increase as your income grows. Another great way to plan for retirement is through mutual funds, which is also our next point on the list. Mutual funds, especially equity-oriented mutual funds, offer inflation-beating returns over the long term. Choose the right type of funds for yourself based on your goal and risk appetite. There are various types of mutual funds, like large cap funds are for stability, as these funds invest in well-established companies only. Mid-cap funds are for the higher growth potential but with slightly more risk. Debt funds are for lower risk and consistent returns, ideal for short-term goals. Also, in these funds, you can make SIP or lump sum investments. SIPs are investing a fixed amount monthly, reducing the risk of market fluctuations. It's ideal for salaried employees, whereas lump sum is investing a large amount when the market is down. It's ideal when you want to invest some amount from your bonus or some windfall gain. Start with SIP of rupees 1,000 to 5,000 per month and increase as your income and confidence grows. Also, track your investments in fixed intervals. Review your portfolio every 6 to 12 months and don't panic during market downturns, as equity investments need time to grow. Lastly, consider building a stock portfolio. This is completely optional. If you enjoy researching companies, allocate a small portion of your portfolio to direct stock investments. But remember, start small and diversify across sectors and asset classes, and always keep learning. Now let's wrap it up with some common mistakes to avoid. First up, don't chase high returns. Investments promising 20 to 30% returns annually are often scams. Stick to realistic expectations of around 12% for equity and 6 to 8% for debt. Avoid emotional decisions. Don't sell during market crashes or invest based on fear of missing out. Finally, keep educating yourself. Follow trusted experts, read books, and stay informed. By avoiding risky investments and following these steps, you will create a financial plan that's safe, steady, and effective. While others chase quick money, you will be building wealth that lasts a lifetime. Which of these steps are you going to implement first? Let me know in the comments below. And if this video helped you simplify investing for you, share it with someone who needs to hear this. Don't forget to subscribe to the channel for more simple and actionable content. Let's make 2025 your best financial year. Thank you for watching, and I will see you in the next one. Tamesh Rajpal signing off.